You are literally giving the bank more money in interest than the value of your home.
Yep.
Right?
Now I'm going to explain to you why it's set up this way. Less interest paid is less profit. This is a profit game, and mortgages are very profitable. I talked about this in our Facebook Live. We do well as a business. You know, thank the Lord, we're blessed. But what I talked about in the Facebook Live that I posted, I think on Friday night, maybe it was Saturday, is you take our abilities and what we know of the market, and let's say we were to offer mortgages. It is incredible to think about how much money we would make if we were offering mortgages or soliciting for mortgages. Yeah. I mean, I'm not going to say we would be responsible. We have already been responsible for billions of dollars of lines of credit being done. Because you got 10,000 families, average line of credit is $400,000. You do the math. It's billions of dollars that we've created for these banks that we don't get to participate in, by the way. So that's the money they make. But if it was mortgages, it is like 7 times the profitability of a line of credit. At least. So and let me explain why. Less interest paid equals less deposit or less profit. So you look at this graph, you got a $250,000 loan, right? So you got a 30-year term, you got a 15-year term, right? So you got 30 years. At the end of paying the 30 years, and this is based on a 4.25% mortgage, you got $456,000 that you're going to pay back. And I love real estate investors. We have tons of real estate investors in our community, but I used to be this person. I buy this home for $250,000, and let's say 10 years later, I sell it for $300,000. I'm pounding myself on the chest. That was a good deal. I made $50,000. I didn't make anything. I lost a lot of money because you don't take into account the financial or you don't take into account financing that property. So you have to look through it through the view of how a South African would look at it, how an Australian would look at it. They look at it through a different lens. They look at it like, okay, it's $250,000, but if I finance it this way, it's going to cost $456,000. So when am I ever going to be able to offload this property for $456,000? If the answer is not in the near future, don't buy it.
100%. Yep.
That's what they do.
And while we're here, I want you guys to pay attention to what Michael's talking about, because on the next slide, we're going to have some trivia, which is great. But we're trying to prove a point here. Rate, time, and balance. Time and balance are far more effective than rate. That's what we're getting at right here. Again, the rate, time, and balance, that financial foundation knowledge is what we're building off of. We're here to, again, equip you with wisdom. So pay attention, because I really want y'all to get the answer right on the next slide.
Yeah, and we're only using mortgage terms at this point to explain time and balance. So what you see in this graph is a 15-year term. It's a lot less in interest. You know, it's over $100,000 of interest less than it would be on a 30-year term. So again, the interest rate only dictates what your payment is. However, the term or the length of the mortgage, being the term, and the balance, that dictates how much interest you're going to pay. And the faster you pay off your debts, the less interest you'll pay.